So we're going to talk about companies that are, well, there's a hard definition for these, but they're either considered mid-size companies, which is smaller than a small company, but larger than a micro-cap company, which I'm not the one making the definitions for those, but really companies that have between $1 million in revenue and $15 million in revenue. You get to $20 million in revenue and you can do a lot more things that probably I'm not going to talk about, but you can vertically integrate at 20 million a lot easier than you can less than 20 million. So we're going to focus on smaller than 20 million, mainly in the probably $10 million range. But we're going to be going over wineries specifically. And I'm going to go through revenue and expenses and kind of cover those topics in more detail. But today we're going to talk about net operating income, which is a term used in finance and accounting to describe basically your net income for operations. So you would take your sales minus your operating expenses. Because there's a lot of differences in the way people account for their operating expenses. Another term that's often used is EBITDA, which is earnings before interest, taxes, amortization, and depreciation. Depreciation, amortization. That's probably a better term, but it's pretty annoying to use that term, EBITDA, all the time. So we're just going to use net operating income. Sometimes owners will not include their pay in operating expenses, and just different things get accounted for when you're talking about operating expenses. So EBITDA kind of makes everybody on the same page when you're talking about that. But EBITDA is really the number we're going to talk about. I'm just going to refer to it as net operating income in the podcast. So what goes into a winery, which could have a vineyard with it, but I'm mainly going to talk about wineries. What goes into the net operating income of a winery? Well, obviously your sales, which would mostly be from selling wine, which you could have wholesale or retail sales or both. You might have wine club, which would fall under retail. You could have other items. You might have some retail items you sell out of your tasting room. You might actually sell your wine before it's even bottled. So there's a number of things that could be in your revenue and your gross sales, but for the most part, it's going to be selling your wine, your bottled wine. Expenses, some of the things that will make a big difference in your expenses, your operating expenses, would be how well your fermentation process goes. And I'm not going to tell you how to make wine, but if you are a winemaker, you will know that your fermentation process doesn't always go smoothly, and you might have more expenses than you initially think. You might have to buy apple juice or other things like that. You might have to go buy some wine from someone else to increase your output. So the fermentation process and how smoothly it goes does impact your net operating income. Obviously, it impacts your costs. Some other things that will impact that might be obviously how many cases you're going to bottle, the number of varietals you're trying to bottle. Obviously, that's going to increase your expenses. So, as I already mentioned, accounting decisions, some people will put their financing into their operating expenses, which is not what you're supposed to do when you're analyzing your net operating income. So, like I said, there's a variety of things that will impact your net operating income that we're going to look at in other podcasts, but I'm just going over a general idea. So obviously kind of covered the fermentation process, but the number of varietals your winery has. Obviously, if you have a number of different varietals, you have different kinds of grapes, and growing those grapes or buying those grapes costs money. Varietals require different labels, so there's a lot of different costs that go into the number of varietals that you have. I would recommend probably minimizing your number of varietals to 3 or 4 at most. Most wineries have some kind of blend. And they usually have a white or a red wine, or multiple whites or reds that they do. But obviously, cutting costs is going to depend on what varietals your winery can do best. If you are growing your own grapes, you want to do a varietal that is well known for that area, that Appalachia. So again, the number of varietals that you're trying to bottle and market and sell will impact your costs. The number of bottles that your cases or bottles you're going to you're going to do obviously impacts that. A lot of people or a lot of wineries will bottle as much as they can. This is specifically if they have their own vineyard. They're going to harvest as much and bottle as much as they can. And that's going to increase costs because you have to buy bottles and corks and cases and all sorts of stuff. So again, the number of bottles you have that you plan on bottling increases your costs quite a bit. So those are going to be some things we'll touch on. There's some other aspects to costs that I'm not going to go over right now. Those are some of them are the ones that will change your net operating income fairly significantly. Some other things that we have. So when you're looking at your net operating income, what we in the finance world like to do is a kind of a percentage or a ratio of the net operating income to your gross sales. This is referred to usually as gross margin, but there's a number of other accounting terms, and I hate going into all the terms, but it does show your efficiency. In other words, how well are you operating in terms of your sales versus your cost? So typically, when you're talking about a smaller winery, and we'll say just $1 million in sales, your net operating income's probably going to be higher than someone that has $10 million in sales because they're going to find some economies of scale. But a smaller winery might have a net operating income to gross sales margin of around 35%, let's say, which is meaning that our costs are higher than someone else. Now, an efficient winery that has about $10 million in sales, if their costs are in line, probably are going to be between the 45 and 50% ratio. And that's a really well-run winery. If you're at $10 million in sales and you're at, say, less than 45% of your net operating income to your gross sales, you're doing okay, but there's probably some areas that you would want to look at. Either you want to increase your sales somehow or decrease your costs a little bit, and there's things we're going to look at to do that. If you're a $10 million winery and you're less than 40% of your net operating income to gross sales, you need to fix some things that you're not operating efficiently. And again, this changes. If you're a $5 million winery, you might be at 42%, and that might be really good just because you're not generating as much sales as a larger winery that has the ability to do some other things. So a lot depends on your particular winery, but we're really looking at, let's just say 40% for any winery between $1 million sales and $20 million in sales. If you're less than 40%, you should be concerned about something. And again, every winery is going to be a little different, but I would say that's kind of the number. If you're at 50%, you're doing really well. And I would almost say maybe you're missing a cost, or your accounting decisions are telling you that a cost that should be operating is not being factored into operating. And where most small wineries run into a problem is their owner's salaries. They tend not to calculate that and put it into an operating cost, even though it is. They will usually be a sole proprietor or a single member LLC or something like that, and they don't factor in what they're getting out of the company, or they don't factor in their hours that are putting into the company at a market rate to determine their real operating costs. So if you're operating a winery and you're the owner and you're at 50%, but you haven't factored in the amount of time that you're putting in, you may not be at 50% NOI to gross revenue. So that's one of the things you might want to look at. So again, the way like a venture capitalist or someone looking to buy your winery would analyze the business would be, let's look at that EBITDA or NOI number, and let's see what the percentage is to their gross sales. Are they operating efficiently? Is this an area where I can bring in some growth, or is this an area where I'm going to be paying a premium in value because of the fact that they're operating efficiently? So it's probably the most important number that I've come across in my multiple years in business is the net operating income, and then more specifically, the percentage of your net operating income to your gross sales. So we'll talk about revenue in the next podcast, how you can increase revenue, and talk about your customers. So thanks for listening.